Hi everyone, and a very warm welcome to this Oakland's webinar entitled Exit with Excellence, the Foundations of a Successful Company Sale. I'm Peter Gray, I'm the chairman of Oakland's based here in London. Just by way of introduction to Oakland's, to those of you who don't know us already, we're the world's most experienced M&A and corporate finance advisors in the market. We've got fantastic global reach with representation in some 40 countries around the world. With strong regional presence across Europe, Asia, the US, and LATAM. And that international presence enables us to provide a truly global service for our clients, whether that involves sourcing overseas buyers on a sell-side mandate or assisting clients with finding acquisition targets to meet their global expansion plans. In terms of our track record, collectively, we close around 400 deals a year. And on average, about a quarter of those deals are cross-border transactions. Now, in addition to selling our companies, we advise our clients on how to prepare their businesses for sale, both to maximize value on a sale, but also, and just as importantly, making sure a deal actually happens. There's almost an infinite number of reasons why deals do not happen. And I think I've seen most of them over the years, but the good news is that in most cases, those causes are preventable by taking appropriate action in advance of a sale. So we've got a stellar and a very global cast of characters on the panel today from Oakland's members across the globe. And I'll ask each member of the panel to introduce themselves, starting with Valerija.
Good day, everyone. My name is Valerija. I'm a partner at Oakland's Baltics, but I also am together with Peter on the executive committee of Oakland's International, and I also run the International Glass Playbook.
Hi, everyone. Doug Kravet. I'm with the Oakland's office in Florida in the United States. And I also sit with Valerija on the executive committee and have a strong interest in agriculture.
Jürg, partner Oakland's from Switzerland. I'm in M&A for 20 years and still enjoy being in this field.
So very good when it's me around. Hatje, managing partner from Oakland, Germany. Like Jürg, I'm since some 20 years in the business, definitely enjoying my job. I'm also part of the executive committee and leading the playbook for IoT solutions.
Great, thank you, everyone. So let's start with Valerija. Valerija, perhaps you could kick off by explaining why exit planning is important in order to maximize value on a sale.
Okay, so first of all, making the decision to sell your business can be a very difficult one, especially when your business is likely one of your most valuable assets and essential element of your life, right? So usually the value of the business is 70 or even more % of your net worth. So it's something really important. Unlike selling a house, selling a business is something you probably do not do, many times over your lifetime. Probably you will just do it once. However, when people sell their house, they usually clean it before they sell it. They usually even do the repairs, but most business owners neglect to prepare in advance for the sale of their business. As a result, less than 30% of the small and medium-sized companies actually eventually sell, which means that very often people just have to close down their business, turn the lights off, and that's it, right? We don't want to do that. So what we at Oakland say is, once you decide to sell, it's actually very critical to prepare, and it's very critical to be proactive about the process. The more risk factors are there in your business, the harder it is to find buyers and to maximize the price. What we say is that preparation actually allows you to mitigate most of these risk factors, or at least decrease the perception of risks for the buyers. My colleagues will add more to that, but preparation process is actually quite a lengthy one. It should start as early as 3 years prior to sale. Well, you can do quite a lot of things in the 6 months, but three years is actually the ideal time frame to make meaningful adjustments to the business that you operate. Remember, your company value is basically two parts, right? It's your profit or EBITDA multiplied by a multiple of X years. Preparation can help you increase both, right? You can increase both your profit, and my colleagues will start explaining you some of the tricks of the trade of sort of how you can do that. But it also can increase the attractiveness of your business, resulting in a higher multiple. So in a way, preparation will increase the value of your business. It will improve the chances of successful sale. It will speed up the sale process, improve your negotiation position, and also ensure that your business operates more efficiently, even if you decide not to sell. So in the next few sort of half an hour, my colleagues will be diving into various elements of business that you need to think about when preparing for exit. They will explain how you can clean up any bad habits you might have on your financial records, how to address your real estate ownership, how to sort of think of other ways of aligning your operations. And I give over to Doug to start giving you the details.
Well, thanks, Valerija. So I think the next question that comes up is what's really involved in planning for a transaction or for an exit. And at a very basic level, what we're talking about is understanding and communicating between the people that are involved in the business. And really at the ownership level, there will be a lot of times different goals and motivations. And so when you're starting to think about an exit, the goals of the ownership group are really important. And I can just tell you from past experience that if the ownership group does not speak with one voice, you're not going to maximize value. That'll lead to the business goals that the company has, which markets to go into, how to make the most optimal investments. All of those sort of standard corporate strategy sort of questions that typically come up. And in order to achieve those business goals and the personal goals of the owners, you're going to need to have a team of trusted advisors. This will be your accountant. There will be a legal team, financial planning, wealth management, insurance, and a number of others. And this type of team needs time in order to make sure that everything's covered and that you can not only achieve the highest value, but also get the most net proceeds out of a transaction, and then make sure that there's not an undue amount of risk on the shareholders as they exit the business. So that's the first point. It's a communication exercise, and it starts with the ownership group. The second key point that I have for today is to document key business processes, because any buyer that's looking at purchasing a company is going to want to understand exactly how the business does what it does. Now, there's opportunities to improve the value of the business by improving processes. And what we'll typically do is bucket the changes that can be made into several different categories. You can do things very quickly, like within 6 months. You can do things that take 6 months to a year, things that take a year or two, and then things that are longer term. And I'll give you two examples from our experience as far as these kinds of changes and how dramatically they can impact the value of a business. So we were working with a company, and they had 12 months or so before they were going to begin the process of the transaction. And they wanted to enter a new market. And they hired a salesperson who was going to be able to develop the market. And it lifted their earnings by about 25%. And because a team was built around this person, and because they had a track record, the sales price went up dollar for dollar times a multiple of the sales and the earnings that this new salesperson generated. The other one that I will share, it's not a positive story, but it is something to be mindful of and to stay away from. I worked with another company that invested in a ERP computer system, and after 2 years of time and effort to get it running, they sold the company, and the system was effectively never used because they got transitioned to the buyer system. So just to give you a little bit of a flavor of the kinds of changes that could and should be made when you're planning for an exit, things that are definitely in the ordinary course and things that are definitely going to make an impact. A couple of other things before I kick it over to Jürg. When we do our planning to help owners get ready for an exit, we will always do a valuation as the company currently operates today, and then another valuation as if the enhancements that we've identified are realized. That way we know where we are, and we have a goal to sort of track against. It's a very useful way of looking at things, and your plan is always going to change over time. But if you don't have a plan, then you've got nothing to measure against. And then finally, I want to just talk about the downside and developing a contingency plan. These exit planning parts of getting ready for a deal are as much about contingencies and risk mitigation as it is about value enhancement. And so every exit plan that we do has a contingency plan attached to it. And I'll give you just one very specific war story. We were working with an entrepreneur that suddenly passed away, and the plan covers everything, but this is just one very specific example. He didn't save the passwords to all of his various accounts and devices and all of that sort of thing, and so no one had access to all of his information, and it took the family 2 months to figure out exactly what was going on. And you can imagine what happened to the business in 60 days after he passed away, and the type of disruption that occurred. So contingency plan is critical. You hope you never use it, but at the same time, it's just something that has to be done. So with that, I'll kick it over to Jürg.
Thank you, Doug. Let's come to the next question. When should you start to prepare for an exit? And in fact, there is a simple answer to that. You should start preparing for an exit as early as possible, preferably already when you set up your business. Valerija also mentioned it before. If you did not start from the very beginning, or not prepare from the very beginning, at least 3 to 5 years before the planned exit or sale, it would be good to start preparation. This has mainly 5 benefits when you do that. You maximize the value, you smooth the transition, it provides you flexibility, it ends up in better negotiations, and it can also reduce stress considerably. How can more time help to maximize the value? Let's make a simple example. For example, a parts manufacturer that supplies 1/3 to the automotive industry, 1/3 to the medtech industry, and 1/3 to various industries. Let's assume the parts manufacturer can increase the share in medtech over the next 2-3 years. That would not only translate in most likely higher margin, it would also allow to position the company differently for a higher multiple, as typically a parts manufacturer would get higher multiples when he produces for the medtech industry than for other industries. That's just one example how more time can help you to maximize the value. Having enough time is also an important element for a smooth transition. Most buyers will require you to be available for a transition period, 2 to 3 years. If you have made the business independent of yourself and have a functioning management team, it may not be necessary to stay very long. So the more dependent the business is on you, the longer this transition period will be, and the more earnouts or reinvestments will become a topic. Preparation time has also an impact on flexibility, and an early start gives you more flexibility in terms of timing an exit strategy. This can help you to respond to changing market conditions. If there is a pandemic, for example, or sudden problems with the supply chain, it might be necessary to postpone a transaction. But on the other hand, it may also be that opportunities arise. For example, I had once a situation where a buyer just knocked on the door and wanted to consolidate the sector and wanted to do a very fast deal. And since we were already in the preparation phase, we had the flexibility to close this deal in a very fast track. Better negotiation. If you start negotiating with the potential buyers or investors early, you get a better understanding on how they look at your business. We do that sometimes on deals, that we have a first phase where we talk to some selected buyers or potential investors, also to learn and then to better position the company in the sales process. And what it will do, it will definitely reduce stress when you prepare early. An exit is a complex and stressful process. It's often underestimated how much time it consumes in addition to operational business. And the more time you have for the preparation, the smoother it goes. In reality, very often companies are not perfectly prepared when we are approached, and we take it typically then from where the company stands. However, with a few suggestions upfront, most companies would have been better prepared. So we recommend to contact an M&A advisor already at an early stage. And we as M&A advisors, we are interested to make these early contacts and to help you with some suggestions. And generally, it's a good advice. You should always manage your company in a way that it is ready for sale, because then you do automatically implement a lot of aspects that are anyway part of good management. That was it for my part. I hand now over to Jan with a few more explanations.
Thank you very much. Yeah, so the colleagues gave you all the good and important advice so far. So what is left for me? Let me talk about some typical misconceptions and failures around an exit. Firstly, as you have seen already from the advice from the colleagues, that one underestimates the required time for an exit very often. There's the time of preparation needed. There's the process time itself that takes some months. Sometimes it takes some years. And then, as mentioned by Jürg, there's often a requirement for the seller to stay for this certain transition period. So don't underestimate the total time, as years are summing up quite easily if you really want to have a very good preparation, very good process, and then enough time to give over the business. Secondly, and even maybe more important, is most of the people are not prepared and have not planned for challenges and problems around such processes. No process is straightforward. There are always issues and problems during the process. Often the seller learns quite a lot about their own company during due diligence. For example, I've advised Germany biggest mushroom producer, and during due diligence of a buyer, they've learned that they have lost their licenses for pumping up their own water. Obviously, for an agriculture business, this is a critical thing. We could heal that and could reapply for the pumps and water access, but the effect could have been dramatic. So therefore, it's very good to identify for potential issues, for potential problems, and to try to prepare for them. There's always good to also brainstorm with external advisors, because obviously, as an internal seller, you're not thinking about critical things, because you're thinking your business is in shape, as everything is running. So please prepare that and expect always additional surprises, which will come definitely. Thirdly, which is also quite, let me say, normal, there's an overvaluation from sellers. It's natural for sellers that they have a different expectations and prices and compared to a buyer. So this is quite normal, but sellers, especially from private businesses, are having a certain emotional attachment to their business. They have built it up from the scratch. They have spent the last 30 years with this business. So therefore, it's very normal that they have not a pure rational view to that. And having this external view is very important, because if you overvalue your business, then it's difficult to argue with potential buyers and to find the right price. It makes the process more complicated. It reduces the likelihood and often leads to failures. But you do not want to waste your money, so the right price is important. You need external help or an external challenge to identify the right price tag, and also understand how to argue with the buyers to realize the premium as good as possible. So to get their strategic rationale and the drivers behind that. So valuation is one of the biggest part of such a whole process. And for a seller, being completely involved into such a process, also emotionally, it's very difficult to have an, let me say, rational and objective view to that. Also, in regard of valuation, there is a misunderstanding of enterprise and equity value. Companies are normally sold cash and debt free. This is meaning that cash, debt, and working capital are very important for the calculation of the final price, meaning not, let me say, the whole valuation, but what will be over for the seller if they get their final payment. For example, some years ago, we have sold a very big salmon smokery here in the heart of Europe. Salmon businesses have peaks around Easter and Christmas because these are the hot times for buying smoked salmon. And due to the seasonality, there was a spread of some 40 million euros in the purchase price, depending on the time in which the signing or closing has happened. So having these impacts and these balance sheet items in mind, preparing for them, neutralizing them if they are harming your valuation is a very important part. So it's not the offer price which you're receiving, but it's in the end what will be left over for you. And this is, again, sometimes very different from the price which was mentioned in the first letter, but then it will be reduced on these items. In regard of that, it's also important, even if this is a task which is not really changeable oftentimes, with the taxation, because in the end, relevant for a seller is what will be left after taxes. But there are transaction structures which are harming your tax position. So during this whole process, it's not only important to look to the valuation, but also how the structure looks like. And for example, also how the wording is drafted. In Germany, I think this is a bit typical German thing, but if you have a wrong wording in the SPAs, then also uncertain future payments will be taxed directly at the first time of signing and closing. This does mean that you are paying the full taxation for a full purchase price, but you just have received 60 or 70%, and the rest might be uncertain. And this can be avoided with right wordings and with right structures. So also this whole valuation and structuring of the valuation is, I would not say rocket science, but it is a complex thing which one should have experience and should have good advice to do not make any mistakes, because these mistakes will cost really much money. This brings me also to a last point, which is not directly obvious, but could be very expensive for a seller. All sellers within the agreements, the share purchase agreements, needs to give certain representation and guarantees to guarantee a certain state of a company at the time of sale. This is not directly a money thing, but obviously a wrong guarantee will cost money, because you then need to compensate the buyer for this wrong statement. And therefore, it's important to also look there through not only the legal wording, but also think about, are there economically issues around reps and warranties, which one should consider and which one should prepare for. So this is also an important part, and which you can really lose money if you have not done it properly. So if sellers have these problems in mind and have prepared accordingly, there will definitely a much better result of the process, not only in terms of valuation, but also in terms of Jürg, as you have said, it's a quite stressful thing and sometimes a roller coaster. So it's good to prepare to avoid as much trouble as one can. Peter, what's next?
Let me kind of summarize, and big thank you to all of our panelists today, and thanks for everyone who's attended today's webinar, and hope there have been some really good takeaways. And one of the messages that I want to convey is, there's that old saying, if you fail to prepare, then prepare to fail, and it's absolutely true in the case of a sale of a business. And as Valerija said at the outset, it's a frustration for us that we often see fantastic companies that perhaps have been approached and want to sell on that basis. They've had a knockout offer, but there is so much that we could have done had we been kind of in situ as advisors for kind of 18 months, 2 years beforehand to achieve a much better valuation. And it's interesting because often a sale process is initiated by a cold approach. You may not be kind of minded to sell, but then someone comes knocking on your door with the oldie knockout offer, and that gets your thinking going in terms of a sale. But Scout's motto: be prepared, because if you are not prepared, if your business is not ready for sale, you haven't sorted out a succession policy, if you're in a situation perhaps where too much of your business is accounted for by one particular customer or any manner of other things that kind of detract from value or indeed prevent a sale, then you will not be able to avail yourself of a fantastic opportunity. So we recommend that clients always be prepared for that knock on the door and start that kind of preparation process as early as possible, including the preparation of an electronic data room containing all kind of the documentation, which in any event is a good kind of business discipline to have, irrespective of whether you're selling your business or not. So yeah, we do have a question. So the question is, what was the most difficult situation where an exit was on the agenda, but the company was poorly prepared and not really ready for a sale, so wasted opportunity? Do you want to take that one?
Let me share maybe a story like it often happens. We had once a case where companies for sale had offered the CEO a management buyout, but they could not agree on the price, and finally they lost the CEO. And it was a company without a broader management team, and so we had to sell the business without the functioning leadership team. It was possible in this case as the buyers were strongly interested in the subscribers of the company. But selling a company without the functioning management is very difficult. And if we had been involved earlier in this situation, we would have advised against the management buyout alternative, and we probably had recommended to set up a proper incentive structure with the CEO, and in that case, that would have worked. So it's one thing that we see often. Somehow companies want to combine a management buyout with an exit strategy, and this never works. And you can sort that out when you do that properly in your preparation phase.
So Jürg, you reminded me of a situation that I was involved with a few years ago. It was a family-owned company, and the owner of the business was a medical practitioner, and he was also the CEO, and he passed away suddenly during the middle of the process. And of course, there was no management succession plan that was in place. You add to that, we had a regulatory issue, and that stopped the deal in its tracks. And there's a happy ending to the story. We worked with the family. It took 2 years, We built up the management team. Their efforts to recruit a non-family member physician was integral. They handled the regulatory issue, and ultimately we sold the business to a private equity backed corporation. Jürg is 100% right. It happens in lots of deals. Management depth is a key issue, and having succession is extremely important.
I have a story without a happy end, if I may add it. It's very, very short, but I've tried to sell years ago a Bavarian company, a sawmill, quite a big size. But in Bavarian, Mittelstand companies are, let me say, very hands-on. And the seller had built all his machinery on the real estate of his neighbor, which was very happy to them. They have met over a beer and agreed to that, how to do that, but they had absolutely no contracts in place. And under German law, this does mean if you install machinery and equipment on third-party real estate, that you transfer the ownership, or that there is a certain likelihood of a transfer of ownership of these assets to this other party, of this owner of the real estate. And as they had no documentation in place, this popped out during due diligence, and the buyer, we have discussed a 3-digit purchase price. The buyer obviously was not well to take these risks, and they could not really solve that in time, so that we needed to stop this whole process and restart it a year later after they had all the legal documents in place. So this was obviously a waste of time and a huge risk to this overall process, and this does mean the preparation of all the things are of utmost critical importance.
And thank you for that. I've also got a war story. I'm sure we all have. Mine's a fantastic one where we had it was a coat hanger business. It was a manufacturer of coat hangers, and the owner was a very colourful character. And the concern of the buyer was that, you know, if he trousered £70 million, then he would no longer be as motivated to carry on the business. And their concern was that, you know, is this person the life and soul of the business? And if he leaves, then the business is not what it was. We were saying to buyers that actually this individual, you know, he'd become a bit detached from the business, spent most of his time kind of fishing and shooting, golfing. He was actually kind of holding the business back a bit because he wasn't taking the decisions or the risks that should have been taken. And we also said, yeah, he's installed a really strong kind of second-tier management team to take over from him. The buyers did not take that at face value, and fascinatingly, they asked us to send a copy of his diary for the last 12 months to show them that he was not meeting customers, he was not meeting suppliers, that, you know, the incumbent team below him were making all the key business decisions. And it is a key piece of diligence from any buyer in terms of the quality of that management team. And the two big roles, clearly, if an owner wants to get a clean exit that they must absolutely fill, the first one is the CEO. If they're going to step back from the coalface, they need a top CEO installed that is going to present the business very well to buyers. And that, in an ideal world, that CEO needs to have been in place for 12 months so that we can show that that person has made, you know, a demonstrative positive impact on the business and is making all the key decisions. He is not just there as a puppet of the owner. He's making decisions independently, and that will be absolutely diligenced. And then the other kind of key role that needs to be filled is the CFO, the finance function. I think in about certainly over 50% of cases, that finance function is perfectly adequate for the day-to-day running of the business, but for a sale process, it is not. Bear in mind that the CFO, you know, needs to be creating 3-year plans, need to be responding to about 700 questions in due diligence, cutting the figures every which way on demand from buyers. So we are constantly installing, you know, interim CFOs or permanent CFOs in order to fulfill what is, an absolutely kind of pivotal role during the sale process. A couple of other questions. Yeah, you focused much of the conversation on well-established companies. Is there any major difference to, say, a company with in a pre-revenue status situation? Who wants to pick that one up?
I'm happy to do so because we advised in the past years a number of startups, either in a pre-earning status or even in the very first beginning. And I would say that it is the preparation is a bit different, obviously, because you don't have any history to show, but it's even more important to prepare in the right way, because you are not selling revenue growth and EBITDA, but more a future potential of a product, of an intellectual property, a software solution, etc. So therefore, to walk through the arguments why this is important, why it should be accepted by the market, and should receive the demand and have the potential to grow and to become a profitable company on its own, is even more important for projects like that. So if you have an automotive supplier with 10% growth and 12% EBITDA margin, I can already predict who will buy it to what price. But having a product which has not any history is more, I would not say a gamble, but it's more difficult to evaluate, and therefore to challenge, have I the right product and the right approach to the market is even more important with a company which does not have a revenue history.
Just to add maybe a little bit to what Jan said, what we see is that for the startup phase, the role of the owner is much more important than in the processes with the well-established companies, where we talk more about the established management. What we see in the pre-revenue companies is that the potential investor, which usually would be, a venture capital fund, they really want the owner to be present in the discussions from day one. They don't want, just the info memo and then first discussions with the advisor and so on and so on. They actually, because there is no real revenue generating company. They basically invest in a person. So I would say that in that, in that aspect, we are basically selling a person. So the whole preparation process is to prepare the person to make the story sound right and to be justified by, all the market data.
Fantastic, thank you. And I've got another question, good question. How to prepare the personnel of the company for the potential sale, and what measures should you take to avoid the risk of losing key employees? How do you lock key employees in, which is clearly a huge part of the value of any business. Valerija, do you want to have a go at that one?
Yeah. Okay, the war stories continue. So what we actually sort of, figured during the last years is that it's better that the employees find out about the process from you than from the outside, right? And there is a risk that the process, we make the process as confidential as possible, but anything can happen. So what we realized is that it's better to have the very key team members, right, that are very crucial for the company, and basically prepare them for the sale than to do something secretly and then in the end have them find it out from a neighbor who has heard it from somebody else, right? So this is probably thing number one. Thing number two is that we feel that the motivation schemes that are sort of geared towards the sale process actually work quite well. Sort of making the bonus structures that are related to the result or actually to the sale price of the company, so that in that very difficult period of sale, and as Jürg mentioned, it can start from 6 months, but it can go into 2 or 3 years, right? And it's a lot of things to do for the management team. So you want them motivated. And usually, the way you motivate them is actually with some amount of the financial gain that they will receive also on the sale of the company.
Maybe I can quickly add on this. I had once a situation where 9 key persons were informed at the very beginning when we started the sale. And you can do that, but then you also need to prepare to incentivize them. And the seller didn't want to do that. He said for loyalty reason, they said, no, be willing to sell themselves, basically. But every person is also closest to him or herself, and it doesn't absolutely work if you have not a plan, incentive plan in place then in such a situation.
Great, thank you. So I think we're up against the clock, so kind of let's finish up, and thank you, as I said, for everyone who's attended today's webinar. So this is the first in a series of webinars on the subject of exit planning. On the next webinar, we'll be talking a bit more about choosing the best time to achieve an exit, and timing, as I said, is perhaps the biggest value driver that there is in terms of exit planning. And in addition to that, we'll look at the various exit routes that are available to you. Until that time, wishing you every success in your respective businesses. Thank you, and look out for the invitation for the next seminar.